Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today we're diving into a really crucial stack of sources, mostly from CNBC and Bloomberg, published just yesterday, Tuesday the 16th, and this morning, Wednesday, September 17th, 2025. Our mission, as always, is to cut through the noise, unpack the big headlines shaping global markets, and hopefully give you some clarity and insight. And wow, we're looking at an incredibly active period. It's really dominated by the Fed decision coming up, some complex shifts in global trade, and the relentless surge in AI investments.
Indeed, it's quite a picture these headlines paint. A global economy really in flux. We'll try to connect the dots today between what the markets are doing, central bank policy, and the strategic moves happening across continents. By the end of this deep dive, you should have a pretty thorough understanding of not just what's happening, but maybe more importantly, why it matters for the bigger economic picture.
Okay, let's unpack this then. Where should we start? The Fed seems like the obvious big one.
Right. The single biggest story today, casting a long shadow, you could say, over global markets, is the end of the U.S. Federal Reserve's two-day meeting. Everyone is just holding their breath.
Yeah, and what's fascinating here is how aligned expectations are. There's this near universal expectation for a 25 basis point interest rate cut. Markets are betting heavily on it, according to CNBC reporting, a reduction from that current 4.25% to 4.5% target range.
Okay, so a small cut is baked in. But it's not just about the number itself, is it? There's the political angle, too.
Definitely.
You've got President Trump pushing for something, well, bigger or fulsome, as he put it.
Right, he urged them on Monday to must cut interest rates now and bigger than Powell had in mind. That's pretty direct pressure.
And then there's the new Fed governor, Stephen Miran.
Trump appointee.
Exactly. And he's almost certainly expected to dissent if it's just an incremental cut. He'll likely push for a more aggressive move.
So that raises the question, beyond the immediate cut, what's the signal for the future?
Yeah.
Because that's often where the market really reacts, right?
Absolutely. The focus shifts immediately to the dot plot. That chart showing where officials see rates going. That's going to be critical. And Chair Powell's press conference, his words will be scrutinized, maybe even more than usual, for any hints about future policy direction. Goldman Sachs, for instance, they expect the dot plot, according to CNBC, to signal 2 cuts this year, not 3. But apparently by a narrow margin, so it's really on a knife edge.
And we saw the markets react cautiously yesterday, right? On the eve of the decision, U.S. stocks dipped a bit on Tuesday. S&P 500 down 0.13%, NASDAQ Composite down 0.07%, Dow down 0.27%. Small moves. It really feels like investors just didn't want to make any big bets before they hear from the Fed. Like one CNBC piece said, it's an awkward limbo.
Yeah, precisely. And you see that caution reflected in the bond market, too. The 10-year Treasury yield was sitting around 4.03%, the 2-year at 3.51%. These are all pieces of the puzzle investors are trying to assemble while they wait for clarity.
So boiling it down for you, the listener, understanding this tightrope the Fed is walking, trying to balance a softening labor market against these worries about inflation, maybe sparked by tariffs, helps explain why this decision is so tricky and why it has such wide-ranging implications.
Exactly. It's a delicate balance.
Okay, so while the U.S. was waiting, how are things looking elsewhere? Let's shift to the global market picture. It seemed pretty mixed on Wednesday.
Very mixed, yeah. Starting over in Asia, CNBC reported quite varied performance. Japan's Nikkei 225 was down about 0.25%, and their exports, they dropped 0.1% year-on-year in August.
Still negative, though.
Still negative, yeah. Less than expected. Economists thought it might be closer to a 1.9% drop, but negative nonetheless. Reflects those ongoing challenges, U.S. tariffs, maybe some slowdown after earlier export front-loading.
And elsewhere in Asia.
South Korea's Kospi lost just over 1%. Australia's ASX 200 retreated about 0.67%. So generally softer in those markets.
But then here's where it gets really interesting, right? Hong Kong.
Yes. Hong Kong's Hang Seng Index climbed 1.7%, and the Hang Seng Tech Index jumped a huge 4.2%.
What drove that?
Well, a lot of it was Baidu. Their shares surged up to 14% at one point. They announced, according to CNBC, a $618 million offshore bond offering and a new AI collaboration with China Merchants Group.
Ah, the AI factor again.
Exactly. And India's Nifty 50 saw a rise, too, about 0.36%. So pockets of real strength.
But then Singapore, a real contrast there. Their non-oil domestic exports plunged.
Plunged is the right word. Down 11.3% in August, completely missed expectations for growth.
Wow, and Singapore is seen as a bellwether, isn't it? Because it's such an open economy.
It really is. Its exports are often seen as a proxy for global demand, global economic health. So such a significant drop there.
Well, it raises serious questions about global trade sentiment, doesn't it? Especially when you see tech in Hong Kong doing so well. It suggests a really uneven picture. Okay, let's hop over to Europe. How did markets open there on Wednesday?
Mostly higher, actually. The Pan-European Stoxx 600 was up about 0.2% in early trade. Germany's DAX led the gains, up 0.5%. And interestingly, British grocery giants Marks and Spencer and Sainsbury's also saw decent gains, adding over 3% and nearly 3% respectively, according to CNBC.
So what are European markets focused on? Same things, Fed, trade.
Pretty much, yeah. They're assessing the U.S.-China trade situation, definitely keeping an eye on the Fed. We also got some UK inflation data. Annual inflation held steady at 3.8% in August. Food prices up 5.1%, alcohol and tobacco up 5.9%. So inflation's still sticky there.
Any other movers?
Yeah, defense stocks were notably higher. Germany's Rheinmetall and Hensoldt gained. There were reports about Indian troops joining military drills near Minsk with Russian and Belarusian forces. That seemed to give defense a lift.
So stepping back, it's really a complex tapestry, isn't it?
Absolutely.
Diverse reactions, different underlying economic signals, export declines here, tech surges there, all reacting to this big Fed event, but also these persistent global shifts. It's not a simple story at all.
No, it really highlights how localized growth and vulnerability pockets are becoming. A broad brush approach seems riskier than ever.
Okay, let's pivot to geopolitics and global trade then, because that's clearly intertwined with everything else. U.S.-China remains front and center.
It does, especially around tariffs and technology. It's fascinating, actually, to see how China is strategically shifting its trade patterns. There was a great piece on CNBC talking about Yiwu, often called the world supermarket.
Right.
Exports from there to the U.S., they've slipped dramatically from about 20% 8 years ago to 15% last year, and now even lower. That's according to one sourcing expert they quoted.
So where is that trade going instead?
Well, China's really ramping up shipments elsewhere. To the Middle East, up 13%. To Southeast Asia, which is now China's largest regional trading partner. And Africa, shipments there surged 24% year-on-year through July.
But that expert also said something interesting, didn't they? About the economics of that shift.
Yes, they put it quite bluntly. Losing a big customer like the U.S. means needing maybe 5 customers in emerging markets to make the same margin. It's basically more work for less money.
And that's driven by the tariffs.
Heavily influenced, yes. Those roughly 55% U.S. tariffs on most Chinese goods, up from 25% during Trump's first term, plus new fees on China-made cargo ships kicking in mid-October. It makes the U.S. market much less attractive, forcing this pivot.
So what does this imply long-term? Is this China actively decoupling?
It certainly looks like a strategic move towards decoupling or at least de-risking from the U.S. market. Short term, it might be less profitable, like the expert said. But long term, it builds resilience, fosters new trade relationships, and really reshapes global supply chains. It's a fundamental shift.
And the tech restrictions play into this too, the TikTok situation.
Right. The U.S. and China reached some kind of framework agreement on the divestiture of TikTok from ByteDance. President Trump extended the deadline again for the 4th time, so that saga continues.
And the chip restrictions.
Yeah, Reuters reported that China's internet regulator ordered top tech firms ByteDance, Alibaba included, to stop buying NVIDIA's RTX Pro 6000D AI chips. It's another clear sign of Beijing intensifying its push to cut reliance on U.S. tech. NVIDIA shares dipped about 1% in pre-market on that news.
Okay, shifting gears slightly, but still on trade and geopolitics. The U.S.-India dynamic. There was that call between Trump and Modi.
Yes, Bloomberg reported on that. They were aiming to ease tensions, particularly over U.S. tariffs on Indian goods. Those had doubled to 50%, and India's ongoing purchases of Russian oil.
How is India navigating that pressure? Buying Russian oil while trying to maintain ties with the U.S.?
It's a tricky balancing act. India's been quite firm, saying they'll keep buying Russian oil if it's financially viable for their energy security. But interestingly, they're also supporting Trump's push for a peaceful resolution in Ukraine.
And the market reaction in India?
Positive, actually. Indian equities traded higher, the rupee strengthened after the call. It suggests some cautious optimism, maybe, that they can find a path forward with the U.S. despite these friction points.
So it's just a really dynamic landscape. Economic policy, tech controls, political relationships, all interconnected and constantly reshaping trade and alliances.
Absolutely. Happening in real time.
And amidst all this, the AI gold rush just keeps accelerating. That seems to be driving a lot of the tech sector movement.
It really does. And you see this fascinating dual narrative playing out. On one side, you have China's tech stocks surging. We mentioned the Hang Seng Tech Index hitting near four-year highs, up 4.3% Wednesday, 42% this year, that's according to Bloomberg. Baidu's jump, Alibaba, SMIC, which is reportedly trialing China's first homegrown advanced chip-making gear, JD.com, all gaining. Chinese tech firms are clearly re-accelerating AI spending. It's projected to hit, $32 billion in 2025, more than double 2023 levels.
Huge numbers.
Yeah.
But then on the other side, you have the UK positioning itself as an AI hub too, right? With U.S. investment pouring in.
Exactly. During President Trump's state visit, Reuters reported that U.S. firms, led by Microsoft, pledged over $42 billion to be precise in UK investments. It covers AI, quantum computing, civil nuclear energy. Microsoft alone is putting in £22 billion for cloud, AI infrastructure, and Britain's biggest AI supercomputer.
And NVIDIA's involved there too.
Yep. NVIDIA committed to deploying 120,000 GPUs, partnering with Nenscale and OpenAI. So it highlights this intensifying global race for AI leadership. Massive capital flowing into infrastructure, research, everywhere.
But it's interesting, while U.S. tech is at record highs, the Hang Seng Tech Index still needs like a 70% rally to get back to its 2021 peak.
Yeah, it's a good reminder. Despite the recent surge, there's still a long way to go for Chinese tech compared to its previous highs. It suggests maybe different stages in the AI boom or perhaps more room to run there.
Now, it's easy to get caught up in the tech dominance narrative. NVIDIA, Microsoft, Apple, Alphabet, Amazon, Meta, Broadcom, Tesla. Yeah, that trillion-dollar club is mostly tech. But Jim Cramer on CNBC pointed out something interesting. JP Morgan, not tech, currently around $850 billion market cap.
Yeah.
He thinks they're making a ferocious move and could be the next non-tech stock to hit a $1 trillion valuation. That's quite a statement.
It really is.
In this AI-dominated era, what makes a traditional bank like JP Morgan potentially challenge those valuations?
Well, Kramer puts it down to just excellence across the board. Lending, capital markets, trading, plus what he called the statesmanship of CEO Jamie Dimon. It suggests that even with AI being transformative, these fundamental strengths, solid management, consistent profitability in traditional sectors can still drive enormous value.
So it's not just a tech story.
Exactly. It shows broader market strength, potentially, beyond just the tech narrative, a more nuanced picture.
So for you listening, the takeaway is, yes, the AI investment cycle is huge, creating leaders, opportunities, but also geopolitical friction over chips. But don't ignore the fundamentals. Strength in other sectors, like finance with JP Morgan, can still lead to massive valuations. It's a diverse market.
Well said.
Okay, before we wrap up, let's touch on a few other notable headlines from Wednesday that add some important context.
Sure. Over in Europe, there's some skepticism about whether the recent equity rally can last. Goldman Sachs strategist told Bloomberg that global investors are kind of waiting. They want to see Germany actually deliver on promised fiscal reforms for defense and infrastructure, hundreds of billions of euros worth. The feeling is, I want to actually see it, not just be told it's going to happen, a bit of show me the money.
Okay. And back in the U.S., housing data was expected this morning.
Yeah, U.S. housing starts numbers. The estimate was around 1.37 million. And interestingly, as CNBC noted, home builder stocks have been really strong lately. Hovnanian up 54%, D.R. Horton up 39% over the last 3 months. Pretty impressive.
But that contrasts quite sharply with consumer sentiment, doesn't it?
It does. Recent data, you can see it on sites like Yahoo Finance, shows consumer sentiment at its lowest point since May. And long-term inflation expectations have jumped up again.
Plus, the job market looked softer in August.
Much softer. Only 22,000 jobs added, way below expectations. Unemployment ticked up to 4.3%. So you've got these conflicting signals, strong home builders, weak consumers, a softening job market. It's leading many fund managers to expect, stagflation.
That dreaded word. Slow growth, high inflation, rising unemployment.
Not a good mix.
And Jim Cramer added a word of caution too, didn't he? Ahead of the Fed decision.
He did on CNBC. He warned that if longer Treasury yields move higher after the Fed announcement, it could spell disaster for this high-flying market. He's still worried about rising inflation, thinks the Fed has no good choices this week because inflation isn't beaten, but the job market looks weak.
So how do these conflicting signals balance out? Strong home builders, weak consumers, tech optimism, inflation fears. It's a confusing picture.
It creates a very volatile and, frankly, unpredictable environment. Sector-specific strength, like home building, might be driven by unique factors, but the broader indicators like consumer sentiment and jobs point to potential fragility. The Fed's decision and crucially, its guidance, will be key. But there's a real risk of getting it wrong, either letting inflation run too hot or tipping the economy into a slowdown.
Yeah. It just underlines how complex and interconnected everything is right now. You really need that holistic view to make sense of it all.
Absolutely.
Okay, so we've covered a lot of ground today, a really packed news cycle from the Fed anticipation, the shifts in global trade, the booming but complicated world of AI.
Yeah, what really stands out from the sources today, I think, is that tension. The
Hmm.
tension between the immediate market focus, what will the Fed do right now, and these much deeper, long-term strategic shifts happening underneath. Markets are kind of in limbo, waiting for Powell, but at the same time, you're seeing huge capital reallocations in AI, major geopolitical realignments in trade and tech. Both things are happening at once.
It really is a moment of both uh, caution in the short term, but also really audacious long-term investment, especially in AI. So, as we move forward, maybe something for you to consider is, how sustainable is the current market momentum, especially in tech, when you set it against this backdrop of geopolitical friction, central bank uncertainty, and maybe weakening consumer confidence?
Yeah, that leaves us with a key question, doesn't it? Given all the political pressure on the Fed, the trade disputes actively reshaping global commerce, and these really concentrated gains in AI tech, how robust is the actual underlying economic recovery? Or are we just seeing a very selective market enthusiasm, one that might be quite vulnerable if those wider economic headwinds start to blow stronger? Something to think about.
Definitely food for thought. Thank you for joining us for this deep dive into today's financial headlines. We hope this exploration has given you some valuable insights and maybe a clearer picture of the forces at play. We'll see you all tomorrow morning with new headlines from major financial magazines.